Are Canadian banks masking the real mortgage default rates? Debt fiasco unraveling. In a sobering analysis of Canada's economic landscape. A video by Debacle Economics published on YouTube.com on September 30, 2023, examines Canada's financial challenges, shedding light on the precarious situation that has been brewing beneath the surface. The video argues that Canada's apparent prosperity, built on a foundation of ever-increasing debt, is poised for a dramatic reckoning, one that could entail more adversity before any potential recovery may be possible. Mounting debt crisis. Canada finds itself at a crossroads, grappling with a host of economic woes. The root causes of these troubles are twofold: rising living costs and a progressively weakening economic environment. For decades, Canada has leaned heavily on debt as a means to paper over its flagging economic performance. This debt comes in various forms, including government debt, corporate debt, and, most notably, household debt. Fragile housing market. At the heart of the crisis lies the issue of mortgage debt, a ticking time bomb that threatens to undermine the economic stability of countless Canadian households. Over the years, as property prices soared, Canadians took on larger and more substantial mortgages, often stretching their financial limits. Now, a disturbing number of these mortgages are teetering on the brink of unsustainability. Negative amortization. A particularly troubling phenomenon known as negative amortization has taken root. This occurs when the interest costs on mortgages become so onerous that borrowers' monthly payments fail to cover the accumulating interest. Consequently, the banks overseeing these mortgages roll over the unpaid interest into future payments. Shockingly, this predicament affects a staggering 22% of mortgages at the Bank of Montreal, 19% at CIBC, and 18% at Toronto Dominion Bank, masking default rates. The video argues that banks have resorted to this technique to mask the fact that many mortgage borrowers are essentially in default. This practice enables them to shield their stock prices and maintain public confidence in Canada's banking system. In the United States during the housing crisis of 2007 and 2008, such behavior by banks was labeled predatory lending. Yet in Canada today, it appears pervasive with little public outcry. Rising homelessness and oversupply. This unsustainable financial juggling act primarily affects investors and homeowners who are in danger of falling into a precarious financial abyss. Some landlords, unable to cover their mortgages with rent, face the difficult choice of either dramatically increasing rents or selling their properties. The former is contributing to a surge in homelessness across Canada, while the latter is expected to flood the market with a glut of properties that may not sell swiftly. Comparisons to the U.S. housing bubble. Drawing parallels with the United States housing bubble collapse 15 years ago, the information suggests that Canada's impending housing crash, if triggered, could dwarf the U.S. experience. Canadian households have shouldered a considerably higher mortgage debt burden compared to their American counterparts, posing a grave risk to the nation's economic stability. Economic challenges. The economic challenges extend beyond the housing sector. Canada is teetering on the edge of a recession, with signs of economic contraction and a troubling rise in unemployment. The video notes that despite robust population growth driven by high immigration targets, this alone may not be sufficient to buoy the housing market, especially if a significant portion of immigrants remains unemployed. Tax increases. Canadians are facing an additional burden in the form of tax hikes. These include federal tax increases affecting businesses, a rise in carbon taxes impacting consumers at the gas pump, mandatory contributions to the Canada Pension Plan, and higher contributions to the Employment Insurance Program. An alcohol escalator tax is also set to increase the cost of alcoholic beverages. Municipal taxes. The financial squeeze extends to municipal levels, where property taxes are poised to rise. Municipalities have grown reliant on revenue generated from housing development, and as developers scale back their activities, there is a revenue shortfall that local governments are eager to offset through tax increases. For example, Vancouver residents may witness a cumulative property tax increase of up to 54% over 5 years. Government policies. The video critiques government policies that appear to be a mixed bag of solutions. On one hand, there are tax breaks offered to developers to stimulate rental housing construction, which may inadvertently boost developer profit margins rather than addressing housing affordability. On the other hand, there are threats of new taxes on grocery stores, which could lead to price hikes, further burdening consumers. The bleak outlook. In summation, the video paints a bleak picture of Canada's current economic trajectory. It suggests that the Canadian dream of financial prosperity is fading fast, and the nation may be forced to embark on a comprehensive economic rebuild. Ordinary Canadians should brace themselves for increased financial strain and fewer economic opportunities in the immediate future. The central message of the video is clear. Canada's reliance on escalating levels of debt to fuel economic growth is unsustainable and threatens the nation's financial stability. It underscores the urgent need for policy changes and responsible financial management to confront and mitigate the pressing economic challenges that lie ahead. Canadian banks may want to mask default rates for mortgages by allowing negative amortization mortgages. There may be several reasons to do so. Banks have a vested interest in maintaining the value of their mortgage portfolios. If a significant number of borrowers default on their mortgages, it can lead to a decrease in the value of these assets. By allowing negative amortization, banks can defer recognizing these defaults and keep their mortgage portfolios appearing healthier than they might be in reality. Public perception of a bank's financial health is crucial for maintaining customer trust and investor confidence. High default rates can erode this trust and lead to a loss of business and a decline in stock prices. By masking default rates through negative amortization, banks can avoid alarming the public and shareholders about the true state of their mortgage portfolios. Banks are subject to various regulatory requirements and capital adequacy ratios. A surge in mortgage defaults could trigger regulatory scrutiny and potentially require banks to allocate more capital to cover potential losses. Banks often prioritize maintaining or increasing their stock prices to benefit shareholders. High default rates can lead to a decrease in stock prices, which can be detrimental to shareholders and the bank's ability to raise capital. A significant increase in mortgage defaults can have a ripple effect on the broader housing market and economy. Banks may be concerned that a sudden revelation of widespread mortgage defaults could negatively impact consumer and investor confidence, leading to further economic instability. With negative amortization, the losses from unpaid interest are rolled over into future payments, postponing the moment when these losses need to be recognized on the bank's balance sheets. In summary, by allowing negative amortization mortgages and masking default rates, Canadian banks can delay the recognition of losses, preserve asset values, maintain public trust, comply with regulations, protect shareholder value, and avoid triggering broader economic instability. However, it's essential to note that this strategy carries its own risks, as it can lead to larger losses in the future if economic conditions worsen or if a significant number of borrowers default simultaneously. What do you think? Is Canada's prosperous housing market built on a foundation of ever-increasing debt similar to a Ponzi scheme and our banks masking this apparent debt crisis? Or is the housing market simply in a pause and will resume its meteoric rise as soon as interest rates start being cut by the Bank of Canada? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.